Welcome to the 2022 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me on this Monday, October 24th, 2022 edition. Please be sure to subscribe to Preach to Me for the latest financial news in the United States and sometimes abroad. I thank you for your support. I read every comment. And now as we begin this new week and coming closer toward the end of the month, and with all the festivities getting closer to the holiday season, we realize now in the U.S. that the mortgage industry is on its way to a slowdown with housing. Mortgage rates are rising up to 7% and greater. And also we have the natural disasters. I want to talk about the natural disasters, how it's affecting farmers, the drought, and the hurricanes that we recently had previously earlier this month and last month. And also stocks. They're having this dead cat bounce, this fake rally where things are going up. As you know, today the Dow Jones closed over 400 points above. And so we can expect these because remember Venezuela 2.0, their stock market melted up to 50,000 before the collapse. And Turkey, Greece, Lebanon, Sri Lanka, you name it. These countries all experienced a melt up of the currency and various stock markets. So let's get right into it. Mortgage industry, according to MarketsWatch.com, they predict recession next year. Well, we're already in one now, as you know, ladies and gentlemen. But they say next year, according to this article, expects mortgage rates to come back down from 7%. The Mortgage Bankers Association, is expecting a recession to hit in 2023. I think now that most major economists, Moody's and S&P 500 stocks, expect at least a 70% chance of a recession. The question is how long this recession is going to last. And as you know, my channel and others have been preaching that this next recession is going to be a severe recession, lasting at least at a minimum 5 years, possibly up to 10 years of the recession, kind of like the last decade that Japan has. But we'll come back to that later on in subsequent videos this week. So they expect rates to fall to 5.4% by the end of next year. Still not a bargain, as you know, that many of these houses for 30-year fixed are above 7%. As if you have perfect credit, 850 FICO, 800 FICO score, and 20% down or 3% down. The conventional loan, 5% down. But it's still high because you know that these house prices are not coming down fast enough in a lot of these communities like Vegas, Orlando, California, all these areas that were hot before, Tennessee, Nashville, all these areas that were hot, now things are a bit of a struggle. And so we're going to continue to see these prices go down, go up. But here's the kicker though. On average, in 2023, this is a quote, expect the economy to lose 25,000 jobs per month. And at the end of the year, employment will be at 5.5%. So we know the numbers are padded, ladies and gentlemen. But we also know as they make these presentations, we already know that we still have, remember, initial claims came down in terms of unemployment, jobless claims, that is, according to the official government numbers. But we know that the continuing claims were rising as the month of September began and into October. That means that people are drawing more benefits, continuing for a longer time because there's not that many jobs available. Remember, we have not only have new college graduates, we have older seniors, retirees that are returning to the workforce because their Social Security and pension check is not quite enough to make ends meet in some of these communities, high cost of living cities. And even in cities that are not high cost of living, the second tier and third tier U.S. cities are experiencing a price increase. I mean, tell me, ladies and gentlemen, when you go to the store, you look at the price of eggs, some cases you're paying $7 for a dozen of eggs. 12 dozen of eggs. The prices of food and gas, utilities, transportation, everything is increased everywhere we look. Gas, according to AAA.com, is averaging $3.95 to $4.02 a gallon. That's for regular at this time, and that's increasing as we speak. So CNNBusiness.com had an article today saying that Florida farmers are experiencing up to $1.5 billion in Hurricane Ian-related losses. We know that living on the beachfront property carries an inherent risk of hurricanes in Florida and all of that, but also the drought. We've had droughts in Texas, Oklahoma, and the nation's heartland, Iowa. The nation's heartland are producing corn, soybeans, wheat, and even in Florida, the Florida farmers, all these orange crops down there in the heartland, they're not talking about away from the beach in central Florida, from the Mount Dora and Lake County line all the way down through Sarasota, Bradenton, inland, in those cities, they produce orange groves and sugar cane. All that was destroyed by the storm surge, ladies and gentlemen. And so livestock too, cows, all the things that they sell in these markets. So it's not just the administrative effects of the buildings and the houses and the businesses that can be rebuilt. The insurance can rebuild that. However, what we cannot get back is the high prices that are going to come as a result of these natural disasters that are going to be plaguing us in the next 2 to 3 years as a result of climate change, global warming, and all of that. Now, also, we have the stock notched the second day gains on Monday, closes more than 400 points higher. Once again, we see this dead cat bounce. Where is the good news that had the stock market up 417 points right now? We have more. They said the earnings report is what did it. Investors will watch for, quote, earnings from big tech names, mainly Apple, Microsoft, Google, and Amazon are due Thursday. So we'll see how the stock market changes. However, we know that the Federal Reserve is going to be increasing rates beginning of November after Halloween, November 1 and 2nd, 1 and 2. They're going to be increasing rates another 75 basis points. It may even be a full point this time. Who knows? It depends on these numbers that come out at the end of this week. But it's possible they can go 100 basis points on the next meeting. So we still have 2 more rate hikes left to go before we end the year. 1 in November, 1 in December, and then 1 in March of 2023, if we make it that far. As far as the economy not, seizing up and collapsing like in 2008. So far so good. So far so good. They believe that the market investors believe that the Fed will pivot, that they will somehow lower these interest rates and stop raising them as a result of the strong economic growth they say that's claiming outside of America and other countries. However, that does not look to be the case right now. We do not expect to pivot. Chairman Jerome Powell has already told us that he's not pivoting. He has to bring down this inflation. They say the goal is 2%. We're at 8.3% inflation right now. That's the official numbers. You and I know inflation is at 19-20% in real life. And they said their goal is to bring it down to 2%. So that tells you right there, even going from 8 to 2%, that takes years of policy to bring it down. You're talking about at least 5 more rate hikes to bring, or 6 more rate hikes to bring that down to at least 3%, 4% inflation. It's not happening overnight. And so because of which, we can expect rate hikes going into 2023 as well. So it's time to batten down the hatches, time to get things ready, get prepared for slow growth, spending in these malls and these outlets and these travel places. People are traveling less. Only essential travel for the holidays is recommended. I would say, I'm not a financial planner, but that's what I would do. And just batten down the hatches and get ready for a slowing economy with less good paying jobs available and more automation and technology jobs available for those who can get those, but for the rest of the people, it's going to be more of an automation technocratic economy, meaning less jobs, higher costs for everything, daily essentials, but we will survive. God has a plan. He's already taken care of us. We know he takes care of our daily needs. It's just going to be a sort of a slow drawdown or a cutback for the majority of Americans, no matter where you live at in this great country we live in. So be safe, be prepared. I'll be back later on this week once the earnings season comes out Wednesday and Thursday with those numbers from the big 5 companies which run most of which run most of the Dow, S&P 500, and so we'll see then. Until then, be blessed. I'll talk to you very soon.